Good afternoon. On behalf of Cipher Accelerator and the Stevens Center for Innovation and Finance, welcome everyone. I am Sarah Hammer, Managing Director of the Stevens Center, Faculty Director of Cipher Accelerator and the Stevens Center Blockchain Laboratory, Senior Director of the Harris Alternative Investments Program, and Adjunct Professor at Penn Law School. And I am thrilled to introduce our special guest today, Mark Cuban, who needs no introduction. Mark, thank you so much for joining us.
Thanks for having me, Sarah. I'm looking forward to it.
Mark began his business career selling garbage bags door to door, eventually creating Micro Solutions, a computer consulting service that he later sold to CompuServe in 1990. He later founded Broadcast.com, streaming audio over the internet, which would be sold to Yahoo 4 years later for $5.6 billion. Mark acquired the Dallas Mavericks in 2000 and has been a star on the ABC show Shark Tank since 2011 when he first appeared. Mark is the best-selling author of How to Win at the Sport of Business, holds multiple patents, and is executive producer on movies that have been nominated for 7 Academy Awards. He is also a visionary crypto thought leader and investor, having invested in OpenSea, Mintable, Polygon, our partner at Cipher, and one of his newest innovations, Lazy.com, among many other companies. And we are very proud to have Mark as an advisor to our Cipher Blockchain Accelerator at Wharton. Mark, thank you again for joining us.
Thanks, Sarah. Thanks for the introduction. It almost makes me sound smart.
Mark, we're so thrilled to have you here today. And as you know, one of our key things that happens early in the acceleration process for us at Cipher is to select our cohort of companies. So soon we'll be interviewing a ton of founders who have applied to Cipher. My first question for you is, from your experience, what are the key things that we should look for in founders, and what's the single most important thing?
I think you look for a willingness to learn, somebody who is adaptive and agile, somebody who loves what they're doing so much that they're the greatest advocate and salesperson for the product and the service. And I would say that the number one thing is commitment. You know, some people start companies because they think they should start a company. Some people start companies because they have an exit plan. Some people start companies because they know they have the best product or service, and it excites them every morning and every night to do what they can to make that company better. And that's what I try to look for.
That's awesome, Mark. We'll definitely be looking for that. And I know that it'll be a thrill to work with people who are really passionate about what they're doing. So I wanted to ask you a little bit, not only about what we look for in founders, but also the company itself. Business model, we'll be looking at the competitive landscape, the regulatory environment. When you invest in a company, if you had to choose, what is more important, the founder or the product itself?
I don't think you can pick one. You have to have both, because if either one is incompetent in its own way, it's not going to work. You know, you could have the world's greatest product service, but if you don't know how to sell it I can't tell you how many companies I've run into where I thought the product was great, but you know, the founder or founders were all engineers and had no interest in selling it. You know, no interest in dealing on the consumer or the B2B side. And on the same on the other way, right, where it's a great potential, great idea, great MVP, but they're all sales and no engineering, and it's very difficult for those folks to talk the language of technology to contractors to try to make it all work. So while a lot of people like to talk about the horse or the jockey, I think you have to have a good horse and a good jockey.
All right, that's awesome. So along those lines, Mark, you have said that one of the most important skills in business is being able to sell. And an example of this was, as I mentioned, your very first business when you sold garbage bags door to door. Yeah. So can you tell us a little bit about that? I think we can learn a lot from that example.
Well, I was 12 and I wanted new basketball shoes. I've always been a basketball junkie. And my dad was playing poker with his buddies. And I was like, Dad, I want a new pair of basketball shoes. And he goes, those shoes on your feet seem to be working really well. When you have a job, you can buy whatever you want. And I'm like, I'm 12, Dad. And one of his buddies playing poker with him was probably drunk off his ass, piped up and said, well, I've got these boxes of garbage bags. Why don't you go out and sell them? And so I did. I went door to door, and it was like, hi, my name is Mark. I'm your neighbor. Do you use garbage bags? You know, and it taught me so much because once you understand your differentiation, which in this case was, yes, they needed them. B, two, I'm cute. You're going to help your local neighbor. And three, it was convenient. That was Amazon before Amazon, offering 1 hour
Right.
delivery. And so, once you understand those elements of selling, things get really easy because I think people confuse selling with convincing. Selling is not convincing. Selling is not selling ice to Eskimos. Selling really is understanding the value of your product and helping people understand how your product or service can help them. And if you have a product or service that truly has value, then you're really going to be able to have an impact. And I think that the analogies to crypto are enormous right now because a
Mhm.
lot of crypto, people look at crypto as being a technology driven environment. It's not. The technology
Mhm.
around crypto is the easiest thing ever. Blockchain,
Mhm.
they're all basically forks of each other. There's not a lot of innovation there. Yeah, you can talk about some of them, and they like to talk about the trilemma and TPS and, maybe
Mhm.
the ICP likes to think that they're a lot different. In some ways they are. But the reality is 95% of blockchains are 95% the same. And the real fundamental value on top of them are the smart contracts. And, put aside all the security and transactions per second, the trilemma stuff. It's smart contracts, and that's just basic JavaScript like programming. There's nothing inherently complicated about that. So it all comes down to using all of those pieces to create products and applications that are differentiated enough that people want to use them and getting to a point of ubiquity with those. So when you come down to, selling garbage bags, what's that have to do with crypto? Well, you have to understand what's going to drive people to use it because it's
Mhm.
so easy to compete. It's so easy to fork, to clone
Mhm.
anything that's out there that you really have to understand how you're going to get adoption. Because if you
Mhm.
don't have adoption, you have nothing. And that's why most of the blockchains the layer ones that are out there aren't going to make it over the long term. And a lot of those have multi-billion-dollar valuations right
Mhm. Well, that's so interesting, Mark. And it goes to one of the things that we've talked about at Wharton, which is there are so many different players in the crypto space. So when you mention, thinking about what the customer needs, how they would use crypto will really vary depending on whether it's a retail investor, or an institution, or a
now. Well,
company that's using crypto.
you're looking at it, don't look at it as tokens or currency, right? Because
Mhm.
other than currencies that are pure store values, or let's primarily store values like Bitcoin as an example, it's all going to be application driven. You see Ethereum doing well because NFTs are doing well. If there was no NFT market, it doesn't matter about 1559 and burning and all that stuff. If people don't have a reason to use Ethereum at all, the price isn't going to be where it's at. It's the utility that drives it. And it's the same as you see the layer twos compete, whether it's optimistic rollups, whether it's ZK, whether it's Polygon versus Avalanche versus any of them, whether it's combining chains like Polkadot, whatever it may be, there have to be applications that get people to use them. Otherwise, it's just another engineering marvel that fails.
Absolutely, Mark. And so um, that goes to one of the questions I wanted to ask you. You invest in tokens yourself, and you've mentioned some of the protocols that we work with at Wharton. How do you make your decisions about which tokens to buy? What do you look at?
Utility, period, end of story. Right? Is there an application? So I originally had some Bitcoin over the years and started building my position there. But as smart contracts started really becoming prevalent and I got more up to speed in NFTs back in January, I think, of this year, then I really flipped over and sold a bunch of my Bitcoin um, near the highs actually and bought a boatload of Ethereum and the guiding principle was just that there was utility with NFTs. And so as long as, and I looked at NFTs not as the end all be all, NFTs for the most part are just collectibles, but NFTs are
Mhm.
proof of concept for smart contracts and how you can enable digital media using smart contracts into any number of different applications. And so that's what got me excited there. I invested in Polygon because, of the pricing, because, it's almost like Ethereum gas fees are like high shipping costs. There are certain
Right.
products where it doesn't make sense to ship them because the shipping costs are just too expensive. And, so not all products are going to fit on Ethereum. And Polygon happened to be the L1, the L2 that really caught my attention again months and months ago. And a lot has changed since then, but I'm still very committed to them. Um,
Mhm.
and if you look at, beyond that, I really, I messed around early just because it was fun to learn on,
Mhm.
speculating on tokens, but I really don't do that anymore. Unless there's an application like, I'm investing in this VCT and KlimaDAO, KLIMA DAO, simply because of its ability to capture carbon offsets and put them on chain and potentially burn them and increase the price of carbon offsets. And if you increase the price of carbon offsets, then you make it more valuable for businesses to create carbon offsets. And you make it easier for people to, if the Penn basketball team, wanted to offset their carbon usage, they could go buy BCT tokens. So that again is an example of application that creates value for a token. So those are the things that I look for when I make an investment now.
That's amazing. And we'll probably want to reach out to you to talk more about that. We are working with researchers around the university who've been working on using blockchain around carbon offsets. So that's
Yep.
pretty exciting stuff.
Yeah, it really
Um,
is.
yeah, very exciting. So making an investment in a startup is tricky, and that's something that a lot of our partners will be thinking about as we run Cypher Accelerator. I wanted to ask you a little bit about that and from your experience as an investor and with Shark Tank, because sometimes handshake deals don't work out,
Right.
and sometimes founders hedge. And you've, in fact, even used a shot clock on Shark Tank in the past to get founders to make decisions about what they will and won't agree to. So I wanted to ask you just a little bit about that and some advice for us. What's the hardest thing about making a deal with a founder?
It really just comes down to the founder's expectations and needs, right? As an investor, do I add value? Yes or no? And does the founder or founders, do they agree with that? Sometimes people come on Shark Tank Friday nights on ABC, 8 p.m. Eastern. People come on Shark Tank and they
We'll
make
be
it seem
tuning
like
in.
they want. Yeah, I got to get the plug. He's always selling.
Of course.
And so they come on pretending that they want a deal when they're really there for the commercial. And so you've got to really get to the heart of what the expectations are of the founder. And it really, when you talk to them, and look, I'm the first to admit I've made hundreds of deals never having met the founder, just completely over email, and made a lot of money just that way because I can ask founders questions, technical
Mhm.
questions, business questions, and how they answer tells me everything. What their needs are, where they have voids, where they're overconfident or cocky, what they don't understand that they think they understand. And all these elements go into the process of not just due diligence about the product or service or the economics, but
Mhm.
also with expectations and
Mhm.
ability to navigate those expectations and the ability to be agile.
Mhm. That's so interesting. And um, one thing you've mentioned in the past, Mark, is that founders shouldn't take out loans. So, us being Wharton and pretty focused on high finance, I wanted to ask you a little bit about that and financing in the crypto space, in the crypto startup space in particular, because as you know, one of the things that we see a lot in our space is a simple agreement for future tokens.
Right.
How does financing in the crypto space, how do you think about that? Do you have advice for
Yeah.
our founders as they're negotiating financing?
Financing for crypto businesses is night and day different than traditional businesses.
Hmm.
Um, and not just because of tokenomics. So if you look at the companies, whether it's Polygon, Dapper, that have raised a lot of money,
Mm-hmm.
most of
Mm-hmm.
that money is not for technology. It's for marketing. It's for
Mm-hmm.
going out and getting people to create applications on their platforms because they're in a death war. All the
Mm-hmm.
excuse me, all the L1 blockchains, there's not a lot of differentiation between them, as I said. And so the difference is who can you get to create applications on your platform that are going to bring users, because users bring consumers of your tokens. And so that takes a lot of money. It's very analogous to what Uber and Lyft had to do, right? Where they had to go out and raise billions of dollars to lose billions of dollars, and continuing to lose billions of dollars. And so it's just a very capital marketing intensive business. And so that's on the blockchain side. Everything else from an application perspective, you almost want to be Switzerland and be blockchain or L1 or L2 agnostic, and be able to transcode your smart contracts across multiple platforms. And if you do that, you start to realize that it's much less expensive to build a business in the crypto world than it is in the real world, the traditional business sense. Because if you look at how crypto works, if you're using an established L2 like Polygon, where the transaction costs are cheaper than Ethereum, then you already have nodes out there that are going to run your smart contracts, or your smart contracts, right? And so that's an offset versus having to get an instance on Amazon AWS, which tends to get very, very expensive very quickly as you grow. You already potentially have liquidity providers for your token. So you're already giving liquidity to your participants, to your users that want to use your service. So you don't have to raise the money like a Lyft or Uber had to do to be able to give liquidity to drivers, to be able to subsidize it. So just those two elements where you have quote unquote servers being provided in exchange for tokens by validators, in a proof of stake world, and you have liquidity providers, if you can bring them in and willing to provide liquidity or subsidize in a lot of respects your user or your users, right? And so that is just such a unique differentiation with crypto that allows you to start a significantly sized business very quickly, and that all that together creates a much more secure environment, so that, and an easier to maintain environment because of the blockchain and the decentralization. And because of that decentralization, if you make it fully trust or as close to trustless as you can get, you're going to need fewer employees, because the smart contracts are doing what smart contracts do and enabling things, without having to have layers of management or people to do it. And so one of the key reasons I get so excited about what's happening right now is, to me, it's very analogous to what happened in the mid-90s with the internet. There was pre-internet where things were very analog, right? Then all of a sudden we made those digital in a very simple manner by my company AudioNet, which effectively started the streaming industry, right? We started with a $3,000 PC in the second bedroom of my house and a free net web server and some HTML and JavaScript that I wrote. And so it took next to nothing, but to scale, we had to raise a lot of money, or I had to invest a lot of money actually, to go out there and buy servers, and we had huge servers farms. And then that evolved to the cloud. But now, if you learn Solidity, which is the smart contract language that Ethereum and compatibles use, and you're able to just have a PC and just do that, right? You're able to build a decent sized crypto business. And so all things being equal, I think we're the same way we saw analog be digitized and put on the net, you're going to see Web 2 be impacted by smart contract based businesses that completely replace. And I'll give you one simple example. I mentioned NFTs or proof of concept. You guys are all in college. Look at the textbook business, right? Nothing worse than buying textbooks, right? They're too expensive, and you try to find used places to buy used books, and you go online or you go to the bookstore, and that's all well and good. But two problems. When you go to resell them, it's a hassle, and you have to go through that whole process. And more importantly, from the publishers and authors' perspective, they don't make a penny on any resale, which means they have to charge more for the textbooks, which makes your education more expensive. Now imagine if all those textbooks were NFTs. And because the way smart contracts and minting an NFT works, you can assign a royalty to all resales. Now, there's some complications, and it's not 100% standardized, but it's going in that direction. So that if I'm the author and I'm partnered with a publisher, and an intro, how to win at the sport of business is a textbook for a business class, and I just offer it as an NFT, and you just buy, I sell a bunch of them initially, and then you just buy them from the students from the previous semester, and I get a 30% royalty from that. I'm happy. My marginal cost is zero. I have money coming in. It's easy for the students. You don't need, to ship things anywhere. It's better for the environment, et cetera, et cetera, et cetera. It's just the path of least resistance for all the pieces involved. Now, nobody's doing that yet, but they will. It's just because the publishing, look, I've looked at it. I've talked to publishers and said, would you sell me these textbooks so that I could do this with them? And they won't do it, right? And they're too stayed in their ways to dive into it because they're afraid of that innovator's dilemma, right? What's going to happen to their business, particularly since most of them are part of public companies. So, but that's just one example. What's the other one? The Cliff Notes, right? There's no good reason for Cliff Notes not to be NFTs. Other examples, architectural drawings, 3D plots. There's so many different things, that can be turned into NFTs where it's a better implementation than the physical books that we have now, or the physical things, or even digital things that we have now. And more people will come up with those types of applications. What the mistake a lot of companies are making right now is they're trying just to do too many Me Too type businesses. Another DeFi, right? Another OpenSea, another marketplace, another this, another that. And that's where they're running into problems. They think if they just do it on a different blockchain and get help from that blockchain, that it's all going to work out, and it won't.
Well, that's amazing, Mark. And I can tell you right now, we have hundreds of students watching this podcast, and they are all in their dorm rooms just right now writing down notes and thinking about starting companies like you did in the second bedroom of your house. So they're all going to be reaching out to us after this show.
Steve Jobs said everything's a remix, and it certainly applies. If you look at fintech, right, what did fintech do? Fintech just took advantage of the inefficiencies of the banking system, and it just simplified some things. Now, there's going to be regulations of crypto at some level, particularly with stable coins. Expect that to come. Don't build a business based upon the fact that there's something that's not regulated. That doesn't have that won't work long. But at the same time, it's so easy to find ways to deal with digital media to simplify things and create a new path of least resistance for consumers or businesses, and haven't even begun to see the applications. I mean, we're not even, it's not even the first inning of the first preseason game. They haven't even gotten out the bats and balls for practice yet. That's how early we are in the crypto.
That's exciting. And you mentioned DeFi. I just want to dig in on that a little bit because that's right in our wheelhouse at Wharton. And Mark, you wrote a blog on this topic amongst other things, and you said that DeFi is incredibly important and a great opportunity for the U.S. So I just kind of want to unpack that a little bit because you mentioned, the infrastructure that we have in place around our financial system and the cost. What for the the benefit of folks watching, what is the problem that DeFi is working to solve in financial services, and has it begun to solve that problem, or are we still in the first inning on that too?
It's begun, but we're still in the first inning. And the number one problem it solves is access to banking for people without a lot of capital. So if you want to have a savings account or even a checking account with under $50, good luck at a bank, because you are not a profitable customer for them at all. And if you're not in the banking system, trying to get into the banking system is even more difficult. Now, look, I'm not saying it's going to be super easy to get started, because you still have to go through the the KYC, to know your customer, and the AML, anti-money laundering things to get money onto crypto, right, into the DeFi system. So there's still processes involved, but whether it's a little bit more expensive at Coinbase or any of the other options that are available, or just working directly with Circle.io and putting money through them just to get USDC to then put in a MetaMask account, or use MetaMask to then trade. DeFi allows anyone to have simpler access to their money in a much more laissez-faire environment. And again, it's not fully regulated now, but it will be regulated just to protect consumers. It's just inevitable. So the cost will go up some, but I still think without question, it's inevitable that at the beginning, the lower end of the market and the unbanked will benefit the most.
Well, that's so interesting, and definitely the financial inclusion aspect is something that we've been really focused on. Can I just ask you, Mark, we've talked a little bit about the regulatory treatment, and you mentioned that there's some activity on that front. We've been paying attention to the PWG, the President's Working Group report on stablecoins, and the hearings in Congress. Do you agree that we need more legislation in that space? Is that you've spoken about the problems of pushing crypto overseas and the disadvantages that's going to pose for us in the U.S. Where are you on all that? Do you think that we need more regulation? Do we need smarter regulation? Should we be more hands-off to encourage innovation at this phase?
Well, there's two things. One, we're losing by having no regulation and all the uncertainty. We're losing businesses to overseas. If you look at the FTX arena in Miami, who just paid a lot of money, or Crypto.com, who just renamed the Staples Center, or we did a deal with the Mavs with Voyager. All of them are based outside the United States, run by Americans. So when you talk to them, they would love to have those companies based here, but they don't know if they're going to be legislated out of existence. And because Singapore and other countries other than China recognize the opportunity in having these companies there with, the employment they bring, the tax dollars they bring, they've realized that it's better to simplify. And so it's not that regulation is bad. And I know there's a libertarian underpinning to all crypto, and I understand that. But the reality is, if we can get, strong enough touch legislation that the people who like a lot of legislation feel that they accomplished something, but not so strong that it inhibits innovation, then I think we can bring those companies back here, because having talked to all their CEOs, they'd rather be home in the United States where they grew up. But you need to have some legislation. And then there's consumer protection. There's a lot of discussion about Tether as a stable coin and where their money is and what would happen if, there was a run there. And I don't have the answer. There's other people who are a lot more knowledgeable on that. But the reality is, if you're going to say it's just basic advertising law, right? And FTC law, if you're going to say you're pegged to the dollar, you need to be pegged to the dollar. And there's got to be a way to deal with that fraud if you're not pegged to the dollar. And once they are, then it becomes a laissez-faire market. And look, I'm recommending to my Shark Tank companies and other investments that are non-crypto based to take a percentage of any cash that they may have, and rather than having it in a checking or savings account, have it in an account that can earn you 7, 8, 9% on USDC. And the next question is, well, how can they pay 7, 8, 9%? It's because people want to borrow it, and if they're willing to pay that because USDC and Tether are usable in any crypto type application or purchase, whether it's for, to speculate or to buy Mavs tickets, or NFTs or whatever you choose, then, it's no different than currency exchange. It's just, the rates that the market will bear. And so I think we need stablecoin, definitive stablecoin definitions and legislation to enforce that. I think from an IRS perspective, I expect that any wallet that has more than $10,000 worth of whatever won't be able to be anonymous. And for those of us who have gotten doxxed, and people know our wallets, it's not that big a deal. But I think, it'll push those people who don't want to remain anonymous overseas, but that's okay, because the people who are crooks are going to do cold storage anyways and have a Tether in their back pocket, and you're not going to see that stuff anyways. But for everybody else, you want to make it a little bit easier for you to do your taxes and for, the IRS to do their job, because otherwise you're just going to have everybody outside the crypto industry using that as an excuse on why we need more legislation. And as long as everybody's always asking for more legislation, it's going to be harder to do. And I'll go back to Uber and Lyft again, right? I mean, Uber, literally, I almost invested in Uber, right? I actually had funded Travis Kalanick's previous company, and we got into a battle about dealing with regulation and legislation and how much it's going to cost to market all this and deal with all that. And, I told him, I don't want to invest hundreds of millions of dollars to do tens of millions in revenue or billions of dollars. And so you've got to recognize that as long as people think you need more regulation, it's going to cost you more and more and more and more to fight it. It's better to get, acceptable legislation and regulation so you can go about being a great entrepreneur and starting a great company. There aren't a lot of industries that haven't grown simply because of regulation.
Right. That's so interesting, Mark. And along those lines, I'm sure you've been following what's been happening with the infrastructure law, and there'll be things that we need to clarify too. We need not only regulation in certain areas, but we need clear regulation that has a deep understanding of how crypto works. And I think that's something that we've been focused on at Penn as well, is just
as long as the SEC is not the enforcing regulator, that's all. Because the SEC likes to litigate to regulate, and that would be bad, right? And chances are they, unfortunately they may be it. And so hopefully we can get them to do some, bright line documentation, because, I don't think people, for the most part, 99% of people aren't looking to intentionally break the law, but if you're a regulator looking for anything on the margin, and there's not bright lines to help people know what they can and can't do, you're going to find violators, and that's going to make things worse. So, and going back to the infrastructure bill, and how they treat brokers, et cetera, there's a lot of people trying to evolve that already. And so hopefully, for last thing I read, they were not going to treat non-brokers as brokers. It's only those who act as brokers that'll be treated as brokers. And that's fine, because if you look at all the centralized exchanges in particular, they know they're brokers, and they're trying to follow all they're trying to deal with expected regulation already. And that's okay to them because they're making so much money. There's a reason why FTX can go, sponsor the former American Airlines arena, why, Crypto.com can kick off Staples Center, in Los Angeles, because they're making so much money. Back in the early days of .com, the companies would raise a lot of money and try to spend those on big marketing splashes, but they weren't making money. They were just raising money. The difference here is, FTX has gone out and raised a lot of money. I don't know if Crypto.com has or how much they've raised, but they're actually profitable and generating, in some cases, millions of dollars per day in profits, not sales, not top line, bottom line, by just selling that spread. And so, it's just a different beast. And I think the right regulation will make the industry even stronger here in the U.S.
That's amazing. So along those lines, Mark, I wanted to ask you, I thought I had read, this might have been in your blog post, that you said in the DeFi world that profits are of no use. Does that ring a bell? I just wanted to ask you a little bit about that. The profits are of no use. And I think it related to how you value a DeFi project.
Okay. So that's in reference to DeFi tokens, right? Because they're DAOs for the most part, right? So they're not going to be there's not going to be profits per se, because they're not built to be profitable. They're built to return. So you're paying some percentage to your liquidity providers. You're hopefully distributing to your token holders at some level, in some manner. And so, whether it's through inflationary tokens, whatever it may be, it's not like they're accumulating profits in a bank account and then they look to invest. Now, I say that there are projects that are making money, right, and accumulating liquidity, and they tend to try to grow the business, but it's driven by the DAO and the community as opposed to being a centralized decision. And so that's really what it comes down to. And then the question becomes, how do you create, if you're creating a new business like we talked about earlier, non-crypto business for that matter, and a DAO is just a new approach to management and everybody participates right off the bat, does that change things in terms of income inequality and employee, or not even employees, but, contributors getting paid in a different manner. Because there's, if you're a contributor and to pick a Dow for my textbook business, right? And you're hosting you're hosting a validator, and it just does all of it automatically. But as each book is bought and sold, you get your stake versions streamed to you, and you're making money right away. I mean, and I'll give you the analogy to that. Like my nephew and my son, my 12-year-old son, and my sophomore at Indiana nephew, they've got Helium Bobcat miners set up. And Helium actually has a product. It's a communications product that they sell to businesses. And those businesses buy the token to pay them for the communications that they use. And those tokens then in turn are distributed to the miners that transmitted, just like a cell tower. Like if you own cell towers, it's somewhat equivalent. And, my nephew bought them, and now he's making 50, with like 8 of them that he paid $300 a piece, he's making $50 a day. And my son has only got 3, and he's making a few dollars a day, but he's also using his gaming PC to mine Ethereum while it's still proof of work. And he's making a couple $100 a month with the price of Ethereum. And he calls it passive income, right? At 12. And so, but you get the point though, that being able to contribute in different ways. So, as you project forward and you look at optimistic roll-ups, not to get too geeky, but there's a challenge period in an optimistic roll-up where people can challenge what has happened on the network via smart contracts. And so imagine doing healthcare claims via smart roll-ups, optimistic roll-ups rather, where anybody can be a claims approver, right? All you need is a phone or a PC, and you get trained, and you get paid to go through the training in the tokens of the platform. And once you pass all the training and it's a learn to earn environment, then you're allowed to become a validator. And once you're a validator, you get to go through and, based on the rules, approve the hospital claims that come through you. And then you have challengers who look for fraudulent approvals or denials of claims. And you take a portion of your income to be a validator. And if you fraudulently, approve one, you lose all the income that you've vested, right, that hasn't been paid to you yet. And if you're a challenger, then you get that money, and both of you get staked earnings. Again, I'm going off on a tangent, but you see the different types of company formations and different ways to use blockchain and smart contracts to change the game in different industries and be very disruptive. And so when I talked about not putting profits at a premium or putting profits first, in a DAO-based world where you can run a company as a DAO, you start to see a different set of economics and a different management hierarchy, if at all a hierarchy. And it becomes, if there's an industry where you can have a truly decentralized company that uses the DAO to manage all this, you can change the game dramatically. I mean, and who wouldn't rather have a medical claim run through a DAO where it's in an optimistic roll-up challenge system, knowing that, if someone tries to screw you over, they're going to lose the deposit they made for that validation note, as opposed to, no, we denied your claim. Okay, let me talk to your supervisor. Talk to the supervisor. No, we denied your claim. Let me talk to your supervisor. Then you go out and hire somebody who goes and renegotiates the claim, and they get it down 70% after going through all that grief. It's just ridiculous the way things operate. And so there will be ways to use these different business forms, DAOs and otherwise, to really be disruptive. Sorry for the long-winded answer, but you asked.
No, it's fascinating. Fascinating. And again, we have a bunch of students just ran into their dorm rooms to start companies related to this.
I hope so.
Before we move on from DeFi, I wanted to ask you about one of the businesses that you've invested in. It's Aave, which looks like a bank.
I'm not an investor in Aave, I'm just a user.
Oh, okay, just a user. All right. So I think that I've heard you speak about it on previous podcasts, but I know that it's a permissionless platform fully controlled by smart contracts, and makes it easy for people to lend and borrow. But I just wanted to ask you a little bit about it and
Uh-huh.
how that business model makes it more profitable than a traditional bank.
They have hardly any employees. They've got employees that, basically deal with managing the Dow and update, monitoring everything to make sure everything's working, right?
Mm-hmm.
And the rest
Mm-hmm.
is pretty much runs itself. If you look at the Instagram of Stanny, the guy who started
Mm-hmm.
it, he's traveling everywhere. He's just having a blast. It's not like he's stuck in an office working 9 to 9. He's loving life and making a boatload of money. Um, you know, it when you in a decentralized finance, a DeFi world like that, it's not necessarily the best economics for the user, but it's simple economics for the user. It makes it really, really, really easy. Just like Amazon might not give you the best price, but the switching cost is enormous, and so Amazon just
Right.
makes it so easy. And so, all the DeFi, whether it's Aave or others, make it easy to deposit money, withdraw money, trade, speculate, lend money and earn income on that. However, and then they even bonus you, just like back in the day, they used to give toasters when you open up a savings account. Now they give you
Oh,
tokens.
right. Yeah. Tokens are the new toasters. That's going to be
Exactly.
our. All right, cool. So you mentioned Amazon, and that's actually one of my questions for you is who in crypto do you think is the next Amazon?
Hasn't happened yet. There's not a next Stripe. There's not a next Square. There's not a next Amazon. I was giving a talk to a bunch of college kids, and I asked them how many of them had crypto wallets. Surprisingly, only half of them did. I was really shocked. And then of those who had crypto wallets, I asked them what was an easier experience to buy something, using a wallet or going through the process, the traditional process right now on Amazon, where you have your credit card already set up and it's relatively easy, but you still have to take those multiple steps. And
Mhm.
the comments were all, well, all you got to do is hit the connect button, and then I go and I buy whatever I want to buy, and it's done. Right?
Right.
It's immediately deducted from my account. If it's just very straightforward and simple. Now that's not a
Mhm.
perfect scenario for everybody, but you know, it's something that I have one programmer working on just giving me ideas where how do you create a Stripe for connecting wallets to traditional commerce?
Mhm.
Because if I've got, I can go to any web page right now that has DeFi or other crypto applications. There's a little connect button there. I just hit connect and it sees what I have there and it knows if I have enough money. And eventually it'll ask me, if I have an account at Aave as an example, it could be anywhere. Then it'll say, do you want to borrow at 3% in USDC to pay for this? Yes or no? And it's just click, click, click. Again, not for everybody, not ubiquitous like an Amazon may be, but it's going to happen. And it always look anything that is consumer driven comes down to a simple proposition. Is it the path of least resistance?
Hmm.
Period. End of story. People
I
always
just,
follow the path of least resistance. We
oh,
got enough going on in our lives. We don't need to mess around with 5 extra steps for something that just annoys the shit out of us.
I'm just laughing because my next question for you was going to be about NFTs and lazy.com, which
Sure.
I was checking out. The platform looks amazing. So, along those lines, I wanted to spend a few seconds on NFTs. What's next for you in NFTs? And tell us a little bit about lazy.com. The site looks fabulous.
Well, lazy.com came about because I bought some NFTs and people kept on sending them to me. Once I set up my account on OpenSea and one on Rarible, people saw what my wallet address was. And so they were able to, and I didn't even realize at the time, I was completely naive. And so they were able to see my two wallet addresses that I was using. And so they would just swamp me with NFTs. Some I had to burn because they were awful, but a lot of them I kept, and then I've bought some. When I buy NFTs, I'm not trying to buy the most expensive Bored Ape Yacht Club. I like going on Mintable or Rarible or OpenSea and looking for great art that I think is just collectible that I just wanted to own. And so there's no easy way to show any of those things. So I happen to own the lazy.com domain. I'm a domain collector. Anytime, I see a domain that's for sale for like next to nothing that I think is easy and memorable, like lazy.com, which I think I got for $100, and I buy it. And so I'm like, look, I got this URL, lazy.com, and I have a staff programmer, and I said, Jesse, I need you to create this for me, um, starting with Ethereum. Took them 3 days. No, it took 6 days in total,
Wow.
including the base time. So in 6 days, we created lazy.com. And if you want to see my NFT collection, you can go to lazy.com/mcuban, and you'll be
Okay.
a backslash mcuban. And you can see that it's really, really simple. And if you want to add your NFTs to it, all you have to do is just connect a wallet, pin the ones that you want to be seen first, and you're done. And so the whole concept was, and then we added the ability to buy and sell, which gave us some revenue. And so the whole concept was, now you have an easy URL to be able to put in your social media bio, or to put in an email to send to somebody. So I can just have, lazy.com/shammer, and Sarah can send all your NFTs to let anybody take a look. And so that's how we did it. And it keeps on growing, and we keep on adding new blockchains. We added Polygon, Ethereum, Dapper Top Shots, Solana, and we're adding Avalanche next. And so we'll just keep on adding them because it's really straightforward and people love it.
Awesome. That's exciting and really fun. I think that's one of the things we're finding at Wharton and across Penn is that students love NFTs. I think they're going to love lazy.com because they're fun, and
Yeah,
they're
it's
creative. And
easy. The
yeah.
people who in NFTs have never answered the question, which picture on your phone do you want to delete when you've run out of storage? Right?
Mhm.
People don't realize that we value digital media as much, if not more, than we value physical media now. There's not,
Mhm.
if you look, I remember there's somebody who was really hesitant about NFTs, and I did a Zoom with them in front of a group, and there was a picture on the wall back there behind him above his couch. I'm like, how important is that picture to you? Oh, it's just there for decoration. So if we threw it away, you wouldn't care. Wouldn't care. Okay, let's look at the pictures on your phone. Which one of those do you just want to give up? And you get it
Mm.
instantly, right? And that's the whole thing
Right.
about NFTs.
Right.
Once you realize it's just an easier to use collectible, but it's also the business side of those collectibles is dramatically easier than physical goods. I
Right.
collected baseball cards as a kid and still have my little collection, right? And you got to worry about grading them. You got to worry about shipping them. You got to worry about not getting ripped off when it's sent to you. You got to worry about
Right.
fraud, all these things that come with
Mhm.
buying and selling anything physical, particularly that's a collectible. I'm not saying there's
Mhm.
no worries with NFTs, but it's a whole lot faster, quicker, simpler. It's the path of least resistance for collectibles. And the other thing to remember in everything that you do with collectibles or store of values, supply and
Mhm.
demand is undefeated. Doesn't matter
Mhm.
what you think, say, or do. All that matters is that there's more demand than there is supply. Price goes up. More supply than demand, price goes down. And and also remember, collectibles are if you look at the historical prices for baseball cards, it's a roller coaster. And it
Mhm.
reacts to other stimuli, and context matters. And the same applies to NFTs. You see a
Right.
lot of people chasing Bored Apes and crypto punks and this and that. They'll have great value as long as there's demand.
Right. Right. It's amazing work. And we actually have a surprise for you in a little bit on that front.
Go.
Um, but before we're going to go to lightning round,
Okay.
and our accelerator managers are going to join us in a minute for that. But I wanted to ask you one question about education, this being Wharton and the University of Pennsylvania, because you have spoken so eloquently about your love of learning and the
Uh-huh.
importance of having education be affordable and accessible for all people. So what just this is a very general question, but what changes do you suggest, or if you could pick one change, what change would you suggest higher education should make to continue to create leaders?
Administrators should never make more than teachers, and you know lower administrators should never make more than RAs. or TAs rather, not RAs. Um, we've got to, there's just so much hierarchy in education that if you looked at it as an economy itself, it, it's it's not self-sustainable. You always have to bring in more and more and more external money to try to subsidize it. And that's a problem. I tried to work with one school that'll go unnamed. I'm like, I give them a list of open source books where I said, all you got to do is print these and give them to kids for free or at cost. And they're just as good. And by the way, I'll help you write a business book that will open source. They don't want to do it because publishers were paying them too much money. And so, trying to run it as a business just doesn't work. There's a school trying to start up, and I said, okay, if you take the community college model, right, meaning it's going to be inexpensive without all the frills and bells and whistles, I'll get involved. And they had no interest in that.
That's amazing, Mark. I love it. And consistent with what you said, we actually have some of our students and accelerator managers who are going to join us now for lightning round. So guys, you can turn your cameras on. They are going to ask you some lightning round questions, and then they have a surprise for you, which I'm super excited about.
Me too. Fire away,
this
guys.
Is Sebastian and Shiva. They're awesome, and we have some others that are joining as well.
Fire away. Who's first?
Guys, okay. Go ahead.
You got for me. And make it good, or I'm just going to cut you off.
I can go first. First of all, I want to thank you for joining us, Mr. Cuban. I enjoyed
Call me Mark. Yeah, call me Mark. I don't like the Mr. stuff.
So, my first question is about Dancing with the Stars in 2007. You know, Bombud, you foxtrotted, you jived, and you waltzed. Kim Johnson called you the Cubanator. What was your favorite dance and why?
Oh my God. Probably the waltz, the first one I did, simply because I just got my hip replaced 7 weeks earlier, so I didn't know if it would make it through the whole dance. And because it was my first really time to really test it. So that was my first. And plus I went on to the second round and everybody thought I was going to be the first one to get booted off. But could you imagine if there was TikTok back then, how much fun and how different it would be? And back then, Facebook was just getting rolling and YouTube really hadn't even caught fire. So all the promotion I did to get people to vote for me was on Facebook.
That's crazy. That's awesome. That sounds like a ton of fun.
Appreciate
All right, I'll ask the next one.
All right, Shiva.
Okay, so this one's about the Mavericks. So it's been about a year since Seth Curry was traded away to the 76ers for Josh Richardson and Tyler Bay. So as somebody who's in Philly now, I have to ask, looking back on this trade, how do you think it went, and should the Mavs have kept Seth Curry?
I hate you. Next question. That answers your question. Yeah, we might rethink it if we had to do it all over again.
Fishy, are you ready? You have a question?
Yeah. Go ahead. You've been involved in politics and outspoken on a number of issues. For example, voicing support for various candidates and offering Donald Trump $1 million to the charity of his choice if he shaved his head. You've even toyed with the idea of
I forgot about that.
Well, now we can all remember. You've even toyed with the idea of running for the president of the United States. So when are you going to run, and what would be your most important issues as president if you did?
Well, I'm not going to run, and the most important issue would be income inequality, and the second most would be the climate, and the third most would, and probably tied for first, is getting rid of both parties. There's nothing more divisive and more counterproductive than having a two-party duopoly, and I think that's a big part of our problem. And so I strongly recommend to any of you out there, if you belong to a party, you're doing a disservice to the country by belonging to any party. You can still stand up for whatever issues you think are important to yourself and fight for them all just as hard. But just being a bandwagoner and jumping along on board with a group just because it's a group, I think is counterproductive.
Okay, Mark, I have a lightning round question for you.
Sure.
Because you've been on film and television, and sometimes you play yourself. I really enjoyed you on Billions. And sometimes you have played someone else, such as the President of the United States. But you have not yet played a superhero. You have not yet played a superhero on film or TV. So if you could be a superhero, which one would you be?
Yeah, I'd want to be failed Iron Man, right? The guy who, or the person who invents things that always fail, but he fails so much, he learns really good lessons and he uses those lessons to help people. So they would call me FIM for failed Iron Man. That'd be the superhero I'd want to be.
That's awesome. That's awesome. All right, so we have, we're running out of time, unfortunately, but we have a surprise for you before we wrap up. And I'm just going to see if I can share my screen. If you just give me a second here. Oh, shoot. Okay. I don't know, Shiva, I don't know if you guys can share, but if not, I have it on my phone and I'll just have to show you here. But what I wanted to show you is this is a custom NFT that our students, our accelerator managers, have minted for you on OpenSea. It's the first NFT minted for Cypher Accelerator. And these guys can tell you more about it, but we'll be sending it to you. And we're just so grateful that you did this with us today. And so we hope that you enjoy this.
I will be looking forward to it. I will put it at the top of my I will pin it at the top of my lazy.com/mcuban account.
All right. Thank you so much, Mark. It's a thrill to have you with us. We're grateful for what you're doing for us at Cypher Accelerator, for us at Wharton and Penn, and for the world. And guys, thanks for joining. It's been super fun. Great to see you. And take care.
Everybody. Thanks, Sarah. It was
All right,
fun.
take care. Bye-bye.